Okay, so you want to own a parking garage. A well-located garage in a busy downtown can generate $30,000 to $80,000 a month in gross revenue, just from people paying to park a car for a few hours. No inventory, no customer service line, no returns, no spoilage. A car pulls in, a car pays, a car leaves. Here's the problem. This business looks like the easiest math in real estate, and it is nowhere near that simple. Whatever profit is sitting in this business, there's an equal amount of risk sitting right next to it, and almost nobody sees it until they already own the building. Let's start with what it actually costs to get into this business, because that number alone eliminates most people before they even get started. Building a parking garage from the ground up isn't cheap construction. It's some of the most expensive square footage you can build per space. A single above-ground parking space in a standard structure costs somewhere between $20,000 and $30,000 to construct. An underground space, which requires excavation, waterproofing, and ventilation systems that above-ground structures don't need, can run $35,000 to $60,000 per space. A modest 500-space garage, which is on the smaller end for a downtown structure, can cost anywhere from $10 million to $30 million to build before it's ever opened to a single customer. Buying an existing garage is usually cheaper than building one, but that's where the real evaluation starts, because not all garages are the same asset wearing the same concrete shell. A garage attached to a hospital, an airport, or a major office tower has what's called captive demand, meaning the people who need to park there don't really have a choice. They work there, or they're visiting someone who does. A standalone garage in a downtown core competing with 3 other garages within walking distance is a completely different business, one where your pricing is constantly being tested by whoever's cheapest that day. The building might look identical from the outside. The revenue underneath it can be worlds apart. Here's where the naive mental model starts to break down. You think the expensive part is finished once the structure is built or bought. It isn't. The ongoing cost of simply keeping a garage legally operational is bigger than people expect, and most of it has nothing to do with parking cars. Fire suppression and ventilation systems in an enclosed garage, especially underground ones, are heavily regulated because trapped exhaust and the risk of vehicle fires in an enclosed concrete structure is a serious life safety issue. These systems require regular inspection, certification, and maintenance contracts that can run tens of thousands of dollars a year on a mid-size structure. Structural inspections are another recurring cost that surprises new owners, because parking garages take a beating that most buildings don't. Cars dripping oil and road salt for years on end causes concrete to deteriorate and rebar to corrode from the inside out. And most cities require periodic structural engineering inspections to catch this before it becomes dangerous. Deferred maintenance on a garage doesn't stay deferred quietly. It eventually shows up as concrete spalling off a ceiling, and repairing structural damage on a multi-level garage can run into the hundreds of thousands of dollars for a single problem area. Now, insurance. This is a bigger line item on a parking garage than most people assume, because you're not just insuring a building. You're insuring against the possibility that hundreds of strangers' vehicles get damaged, stolen, or broken into while under your care every single day. Liability exposure here is genuinely different from most commercial real estate, and premiums reflect that. Let's talk about how the money actually comes in, because it isn't just one stream. And understanding the mix explains why some garages print money while nearly identical ones next door struggle. The first and most obvious layer is transient parking, the hourly and daily customers pulling in without a reservation. This is usually the highest rate per space, but it's also the least predictable, swinging hard with weather, weekday versus weekend, and whatever events are happening nearby. The second layer, and often the more important one, is monthly parking. Businesses and commuters who pay a flat monthly rate for guaranteed access. Monthly parkers pay a lower rate per use than someone paying by the hour, but they provide something transient customers can't: predictable, recurring revenue you can actually build a budget around. A well-run garage tries to fill a meaningful base of the building with monthly contracts first. Then let's transient parking capture the premium pricing on top of that guaranteed floor. The third layer is the one most first-time owners completely miss: dynamic and event-based pricing. A garage sitting 3 blocks from a stadium or a concert venue can charge multiples of its normal daily rate on event nights. Sometimes $40 to $60 for a few hours when the same space might go for $12 on a quiet Tuesday. This is where the real upside in this business often lives. And it's also where a lot of the operational complexity comes from, because managing that kind of dynamic pricing requires either sophisticated software or staff who actually pay attention to the calendar of everything happening nearby. Here's the part that quietly determines whether any of this works. And it has nothing to do with the parking itself. Technology and staffing. Older garages that still rely on ticket booths and attendants are bleeding money in a way that isn't always obvious on a spreadsheet, because every attendant on payroll is a fixed labor cost running around the clock, and manual ticketing systems are notoriously vulnerable to what the industry politely calls revenue leakage, and what everyone else calls theft. Cash transactions that never quite make it into the books. Modern automated systems, license plate recognition, app-based payment, and gateless entry cost real money to install, often $500,000 to a few $1,000,000, depending on the size of the garage. But they close most of that leakage and cut labor costs dramatically. The upfront cost is steep. The garages still running on the old model are often the ones quietly losing the most money without their owners ever seeing exactly where it went. So, here's the honest math on a mid-size 500-space downtown garage. If you're averaging even a modest $150 per space per month across your blend of monthly contracts, transient parking, and event pricing, that's $75,000 a month, or $900,000 a year in gross revenue. Sounds enormous. Now subtract debt service on a facility that may have cost $15 to $20 million to build or acquire. Subtract insurance. Subtract structural maintenance reserves. Subtract staffing or the technology investment to eliminate it. Subtract property taxes on a large commercial structure in a major city, and that $900,000 gets thinner fast. In a strong location with modern systems and a healthy mix of monthly and event revenue, owners can see net margins in a genuinely attractive range. In a mediocre location competing with 3 other garages on price, that same building can limp along, barely covering its own debt service, looking busy every single day while producing almost nothing at the bottom line. In the optimistic scenario, you've secured captive demand near a hospital, office tower, or stadium, invested in modern automated systems that eliminate leakage, and built a strong base of monthly contracts that keeps cash flow stable even when transient traffic dips. Under those conditions, a well-run garage can be one of the most reliably profitable pieces of commercial real estate a city has to offer, low on operating complexity compared to running a hotel or a restaurant, with demand that doesn't disappear just because of a bad news cycle. In the realistic scenario, a new garage opens 2 blocks away and a price war begins. Your structural inspection turns up a repair bill you didn't budget for. Or the office tower you were counting on for monthly contracts goes half empty because of shifting work patterns. And suddenly, your captive demand wasn't as captive as you thought. The difference between those 2 outcomes usually isn't visible from the street. Both garages look full. Most afternoons, the difference is buried in the maintenance reserve, the technology stack, and whether the demand around you was ever really guaranteed in the first place. A parking garage looks like the simplest business in real estate, a box that holds cars and collects money. What it actually is, underneath that simplicity, is a heavily regulated, structurally demanding asset where the profit and the risk grow from exactly the same source: the number of strangers you're trusting to drive in, park safely, and drive back out again every single day for decades.